It's time for Ultimate Options. It's time to rock and roll. I'm Andy Tanner. I'm with Corey Halliday, the Ultimate Options instructor. I'll tell you that. He's a stud. And it's just good to have you back with us. And Corey, you ready to rock and roll?
I'm ready. I'm having a ball.
You know, we're on the downhill side now. This will be part 4 of Greeks, and this one's a piece of cake. You know, we spent a good hour and 45 minutes, something like that, probably on each of the other Greeks that we cared about. And we'll certainly probably get to beta at some point. But after this, we'll have a good enough understanding of Greeks where I feel good about us moving on to some other tools, some other foundations. But understanding the Greeks was really important first. So with that, let's talk about the disclaimer, which we'll probably have memorized by the time we do every single class in the series. But it just basically says 2 important things. This is risky. That's the bottom paragraph. And it's for grown-ups. It's a personal decision to go into debt or to buy a house or to start a business or any other investment. It's a very personal thing that some people are really happy. I can go out and I can lose $10,000, $50,000, whatever, and it doesn't always freak me out. It sure as heck isn't fun, but I've done that many times in my life, right? And so it doesn't freak me out. I've in fact I've lost bigger than that in businesses and things like that. So in terms of teaching, this is important to understand. We're just educators. We're just educators. So while I'm not, ever going to go out and lose 50 grand, in stocks and in options, I've done it in other venues and other projects, and my risk tolerance is high. But we've also had tremendous rewards in certain businesses we've started. So it's really a personal thing. Okay. So with that, let's just hop into some of these ideas on some of these other things. So, if you're an engineer, you got this. If you're one of these physics guys, you'll have this nailed. But this is what acceleration looks like. So let's just take it out of the context of stock a little minute, and let's talk about this, car right here. And you talk about going 0 to 60. And it looks like this one's hitting 0 to 60 in 4.5 seconds. So that's what people like to talk about is, 0 to 60 in 4.5 seconds. So, here's the first half second, second and a half, 2 seconds, 2.5, 3 seconds, 3.5, 4 seconds, 4.5, 5 seconds. So what's interesting is, a person might have thought, well, if you drew this freehand, you might say, that's what it looks like. And that's not. That would be different to where the speed, is increasing at a constant rate. And that's not usually how things accelerate all the time. It also, you could have a motorcycle that really jumps out of the gate quick. And, it just gets to 20 immediately and just sets you back in your seat. But then it, kind of tops out. Maybe it's got a top speed of 60 miles an hour and it stops accelerating and, 60 is as fast as it can go. That's probably what a whippet would look like, a little mini greyhound. Those suckers accelerate huge.
Yeah.
but then the greyhound, catches them and goes faster. So, and maybe the top speed is 60, and once it's 60, in the 4.5 second, the 5 second, the 5.5, and the 6, it's steady. So, acceleration is different than speed, and what a really acceleration velocity, or speed velocity is, how many miles you can cover. So it's a distance over time, miles per hour, right? Miles per hour. We could say it that way, And so it's a distance over time. Well, then you divide by time again, you're saying, what's the per second, right? Acceleration is often a distance that you cover per second. And so why is this an important thing? Well, my experience, if we just go to this red graph again, right, at my hashes here, my experience of sinking into the seat gets really cooler right here. I mean, this is really the sexy part right here, right, Corey? This is where I kind of feel myself sink back in the seat right here, and then I feel myself sink back a little more right here. But this is really steep. So if I wanted to really get the acceleration, I would look at the slope of this line. And so a slope, rise over run, the rise and the run. The slope, this is a very soft slope, right? But this, right here, this is a very soft slope. This is a ramp that's not very steep. This is a ramp that's way steep. So, you're really looking at the slope of this line right here to say, hey, where is the strongest or the highest acceleration? Anything you want to say about that?
Yeah, you can kind of think, if you watch Usain Bolt run.
Oh, baby.
He's got those long legs, and he is the fastest human being, right?
Yeah.
However, in those races, like the 100, usually he's a little bit behind at the start because he's got the long legs, but once he gets to top speed, I mean, he is absolutely flying, and he's accelerating towards the end at such a faster rate than everyone else.
It's true. Usain, if he could run 80 miles an hour, would run like that, right?
Yeah.
Where he's kind of behind, and then late in the race, he just passes everybody else in their velocity right here. He gets, and then he just rockets by him. So, and gets top speed. So his acceleration at the end is stronger than his acceleration at the beginning. So why do we care about this? Well, if you remember what delta was, delta was how much we moved in the first dollar move. So let's look at the first second right here. And, we've gone from 0, and here's our first second, and we're about 1/3, up this chain. So we're about 7 miles per hour here. So, if we wanted to look at, a delta here, we'd say, how much do we move in the first second? Well, we moved about 7 miles per hour in the first second, right? In the first second. That doesn't tell me very much about how much we moved here in the last second, because in the last second, we're going from looks like about 42 miles an hour to 80. So we got a 38 here miles per hour down the road. So the problem with delta is proximate to where you are right now, right? Delta, here I am right now, and in the first 1 second move, it tells me what I'm doing in the first second. I say, oh, that's only a 7. That really doesn't prepare me for the rush I'm going to have in the 4th and 5th second, right? And so I want to know the average rate of change of delta. I want to know, all this acceleration is showing us is the rate. This is how fast it's going. That speed is changing, right? Or velocity is changing. It's showing the rate at which speed is changing. And so, if I go approximate on this and I only look at the first 1 second, I get a 7 mile an hour deal. That really doesn't describe my experience down here where I'm going to have a 38, which is about 5 times, that's about 500% different down the road than I'm experiencing here.
Yeah, and you can kind of think of it in terms of if this was constant at 7 miles per hour in 5 seconds, you'd be at 35, right? 5
Yeah.
times 7.
Yeah.
But it's
You'd be
clearly
right
way
about-
different than that.
Yeah.
And so to use the stock example, to use the delta, your delta is the first dollar move, but remember that delta is changing. And you already know that instinctively, because if I were to ask you, if Andy and I were to quiz you a little bit and we said, what might a delta be at if it's an out of the money option? And you'd say, if it's an out of the money option, it might have a 20 delta or something like that. It's going to be lower. And then I say, okay, well, what is it going to be at roughly when it's at the money? And you're going to say, it's going to have jumped to 50. And then I say, okay, well, what's a common in the money delta? And you're going to say, okay, that's all the way up to 80. So that delta is changing as the option is moving from maybe an out of the money to an at the money to an in the money. And so that's where we get into gamma. Gamma tells us how much that delta is changing. It's telling us what that shift, that acceleration is. So in the car example, it's kind of, it's brakes and gas. We can speed up, we can slow down.
Yep.
In the options market, that's what gamma is showing us. It's showing us how much we're increasing or decreasing in the delta. So
I'm going to draw this right here of intrinsic value and time value. Okay, intrinsic value and time value. And I'll show you something that's very, very important. If you look at a stock the stock has all intrinsic value and has 0 time value. It's all intrinsic. So for example, a stock would look like this. Here's my break-even point. And as it goes up $1 per dollar, okay, and here's where I bought it at, and it goes down dollar per dollar. We'll just make this line blue. This blue line represents, my risk. Here I'm making money, here I'm losing money. So maybe this stock's at $50. So at $51, I make $1. And at 52, I make another dollar, right here. And at 53, I'd make another dollar. But at 49, I would lose $1. And at 48, I would lose $1 and so forth. So a stock is all intrinsic value, and it's going to it's going to really have a delta of 1 every time, because in the first dollar move, I make $1, and in the second dollar move, I make $1. So a stock really doesn't have a change, if that makes sense. It really doesn't have a change in delta ever. If I get clear out here and it goes up another $1, I'm going to go up another $1 here. So there is no gamma in a stock, right, Corey?
That's right.
There's no gamma.
And long stock is a positive 1 delta, and of course short stock would be a negative 1 delta. Just like calls have a positive delta and puts have a negative delta, but they're always changing. You're making penny for penny or dollar for dollar, in other words, what that stock is doing, or losing if it's going against you.
Now, if you look at a stock at an option at expiration, for example, okay, I might have my same graph right here of 0, and this is the money I make and this is the money I lose. And maybe I have $100 here minus and, $100 here plus, because there's 100 shares per contract. So maybe the stock option costs me $1, and maybe I have a $50 strike price. So here's 49 and 48 and 47, and here's 51, 52, and 53, and 54. So if I have a call option and it costs me $100, I know that if it's at 50, I have the right to buy at 50. And so that's great. I can buy the stock at 50, and I would just lose my premium. I'd lose that $100 because, if I have the right to buy a stock at 50, and the stock's already at 50, no one's going to give me any money for that because they can go buy it on the market. Let me say that again. if the stock is trading at $50 right here, and I say, hey, I got this really cool contract that lets me buy the stock at 50. So you're really in a scenario here where you could buy it from me. You could buy this option for me that lets you buy it at 50, or you could go yourself and buy it at the market at 50. Well, why would you pay me extra money to do what you could do yourself? I'm not special at $50, right? I'm just not.
And another way to describe that is when you bought it, you paid 0 intrinsic, but $1 of time value.
Yeah.
If you're at expiration now and the option is the stock's still just right at the strike price, what happens at expiration? Well, we know the time value is at 0 and the intrinsic is at 0. So your option's not any more valuable than what you can do in the open market. And that's why you paid $1 for it,
100
but
shares.
actually it's now worth 0. It's basically just gives you the same ability that you can get in the open market. So there's nothing special about it, like you said. So you lost the time value in that option.
Now, if the stock was at 53, okay, so 51, 52, 53, okay, that means I could buy at 53, right? Or I could buy at 50 and sell at 53. So that would be, $1, $2, $3, $300 minus the $100 in premium. So I'd come up here to, $200 right here. So at 53, this option's worth $200. At 52, it's worth $100. At 51, I'm pretty much break even. Someone would give me $100 maybe to buy at 51 or to buy at 50. If the stock was at 51 and I could buy at 50, the intrinsic value is at $100. So this gives me a graph here, and I can see that my delta, if I get in the money, once I get in the money, my in the money portion, in other words, the part above 50, has a delta of 1. There's no slope to it, okay? And it has no gamma because the delta isn't changing. It's 1 right here, it's 1 right here, it's 1 right here, it's 1 right here, it's 1 right here. There is no gamma because the delta is going to be 1 in this first dollar move, second dollar move, third dollar move, fourth dollar move. Wherever it resides at expiration, there's no gamma here. There's no change in the rate. There's no acceleration. In order to have acceleration, this thing has to bend. It can't be a straight line. Does that make sense? It's just 1 the whole way. Does that make sense, Corey?
Yeah, because what we're doing here is saying this is where you'd be at expiration. So remember, at expiration, there is no time value left. Yeah. So this graph just simply shows how much you're in the money in your option. Yeah. And if you're in the money $1 on your option, you're still only at break even because you paid $1 for that. You paid $1 of time value and it's gone to 0. But it's gained $1 of intrinsic value. That's just a wash. And so that's why at 51, we're still only at break even because we basically replaced our loss in time value with a gain of $1 in intrinsic.
Yep.
Now, if it keeps going, though, we keep gaining intrinsic. Yeah. So it goes to 52. Now we're up 2 in intrinsic. We still lose our time value.
Yeah.
But now our option we paid 1 for is now worth $2. Yeah. And it just keeps going. That's exactly right.
And the rate at which we're making money isn't changing. I mean, we're still making money at a constant rate here. We're going from 3 to 4 to 5. We're making $1 for every dollar move. So it's not changing. Up $1, it's sleeper. $1 up, $1 in the pocket. Another dollar up, another dollar in the pocket. $1 up. It's not changing at all. Now, the out of the money portion is there's 0. It doesn't change at all. I'm losing I've lost $100 here, $100 here, $100. At least here, this is changing. At least this is changing here, but this is not. So it's constant on this side. the rate at which this is changing is constant. It's 1 here, and this is 0 here. And so on one side it's 1, on one side it's the other. Now, here's what's interesting though. If I look at my option at purchase, at the time of purchase, it might be 100% time value, right? Especially if I do an out of the money option at purchase. It's going to have 0 intrinsic value, and it's going to have time value. And so what happens is when you buy a put option, if I decide to sell it back the moment that I buy it, I'll break even most likely. I mean, yeah, you got the spread, and maybe I bought it for, maybe I bought it for $1 right here, and I sell it back for 98 cents. Okay, so I'm just going to call that a wash, because on the same day I purchased it, the very same second that I purchased it, I can get it in and out. And if I get a good midpoint, if I shave the spread and I get a mark on it, I might get in and out for only a loss of a penny or so. So I have some time value here. And if I don't wait till expiration, I get a refund basically on my time value, where this guy says, well, look, I'll give you some money to buy at $50 because I have a month here. And at least I'm getting some time to see if it could go higher. So yeah, I'll buy this $50 strike call from you because you have 1 month left, and that's worth something to me. So yeah, there's some time value here. I'll give you $100 for time value, 100 shares. I'll give you $1 for it. And
That's
so let's say now I want to figure out how much I'll make in the first dollar move. Well, let's say it's right, just barely at the money, it's going to have no intrinsic value if it's at the money, but it is going to have some time value. So if I say, look, it's 50. Okay. Well, then I would draw a line right here between 50 and 100, because I know I'll make $50, right? And then between 50 and 49, I know I lose $50. So this tells me
you have a 50 delta
right,
in that case.
Right.
Exactly
so now
right.
I do have a delta, right? And I have a delta right here of 50. Okay, like that. I have a delta of 50. Well, notice that this angle, as I go up further and further and further, is going to get steeper and steeper and steeper, just like this graph. And it's going to get softer and softer and softer and softer and softer till it matches this one. And as time decays, it'll start fading down, to look like the black line. Well, the delta only tells me what it's doing in the first dollar move. It only tells me what's happening here. Obviously, from 53 to 54, I have a much steeper angle. And so what the gamma does is it tells me what's going to happen out here. It tells me what's going to happen and how quickly this is going from an angle like this to an angle like this, or from an angle like this to an angle like this, or from an angle like this to, this is the nasty one, to an angle like this. Yeah. And so gamma tells us so delta tells us about what's proximate, right? What's going to happen proximate, right? Delta is proximate. Gamma helps give us a vision of what's going to come down the road. So
yeah, I like to call gamma the second dollar move.
Yeah.
Because you basically take, so if your delta's 50,
yep,
and your gamma, let's say it had a gamma of 20. Gamma tells us what the second dollar move is going to be. We add the gamma to the delta, and that's going to be the second dollar. So
right,
if the first dollar move is going to be the delta, which is 50. Now, what's the second dollar move? Well, whatever the gamma was, add that to the delta. So 50 plus 20 would give us 70. Okay, the delta is now at 70. It's how much the delta changes after that first dollar move. That's what Gamma tells us.
And it's interesting because if I see a huge move if I see a pretty, my delta's here and then my next dollar's here, it can tell me how nasty it can get and gives me an idea of how it's changing dollar per dollar, as I go up this. So Gamma is not something that we're going to freak out over. It's not something that we're going to use a lot. And, if you like risk graphs, you can kind of see what the Gamma looks like. If your risk graph looks like this, you've got a higher Gamma. If your risk graph looks like this, you've got a lower Gamma. And so if it really doesn't matter, why would we take the time to talk about Gamma? Well, in other words, why would we want an estimate if we're not going to use it very much? If it's not one of the big three we talked about, if it's not going to be something we focus on too much, why learn about an estimate of how fast delta will change as the price change in that second dollar move, which gives us idea of what can happen in the third dollar move, and so forth. It helps us see, if I see this car accelerate here in the first couple seconds, then in the next move I see it getting even steeper, I might believe it's getting even steeper. It just gives me a sense of how that's changing. Well, Gamma risk will just tell you how fast things will get nastier and nastier for you if the price moves, against you, or better and better for you. We could, I hate to be negative on that, but since this says Gamma risk, it'll tell you how fast things get nastier and nastier. And if the answer is no, they won't get nastier and nastier for me with the price change, then you have low Gamma risk. But if you have a price that with the price change and a delta change, if the change in delta is going to hurt you, then you'd have a high Gamma risk.
Yeah, and so it depends on what your strategy is as to whether Gamma is helping or hurting. If you are long options, meaning that you want the delta to increase, right? With calls and with puts, we're directional. We want that delta to keep climbing and climbing. In that case, it would be Gamma reward, right? Because if I have a delta of 50 when I buy my call, and that Gamma over there is big, let's say it's 25 or something, well, then that's Gamma reward, because if it jumps to the second and the third, now all of a sudden my delta is much, much higher. The downside is when you're selling options, when you are the insurance company, you're oftentimes saying it can't go here, it shouldn't go here. I'm willing to make a promise that it won't go here, and if it does, I have to fulfill that promise. Well, now you're short delta. You're saying, I don't want this price move. And so the Gamma, the increase in that delta, is a risk to you. So there's reward and risk. It all depends on which side you're on.
If to give a visual of this, and by the way, you're going to learn how to draw these risk graphs without a computer coming up here in another segment or two. We're about 2 classes away, and you're going to be learning how to draw all these just as quickly as Corey draws them and I draw them. And I'm going to give you a little secret that people in the Mentor Club don't know. You ready for if you're in Mentor Club, but you're also taking the Ultimate Options, I'm going to tell you a secret. Corey, when you trade, do you use risk graphs?
I don't. I don't typically, unless I get into a complex, multi-leg or ratio spread or something like that. I might glance at it, but for the most part, no.
Because with a long call, short call, iron condor, vertical spread, bear, maybe it's like a bull put spread or bear call spread. We can see these in our head. Don't tell anybody that. Yeah. We make a big deal out of the risk graphs in the Mentor Club because it helps people visualize, but you're actually in this options course. If you do this right, you'll be able to see these in your head. And some people just freak out. They're like, oh, I'd never be able to do that. I'd never be able to do that. you're going to be able to do it. Anyway, so this is my expiration line. This is what it looks like at expiration. And so maybe I have, this break even right here at this dollar, and I have a line that looks something like this for my time value line. And maybe, right here, I sell this call, and maybe it looks something like that. Would you say that's okay, Corey? Something like that?
Yep. Perfect.
Well, right here, now watch this. Right here, my max risk, let's put this in red because it's risk. My maximum risk is my premium. There is no gamma risk per se. I mean, I guess you could say this acceleration of it, but really my maximum risk is the premium that I paid. As this thing gets nastier and nastier and goes lower and lower and lower, pretty soon I just bottom out here at the amount of money I can lose, no matter how far down the stock goes with this long call. Right here, my max risk does not exist. There is no maximum risk because it's infinity. Because this stock could go forever up, which means this promise could go forever down. And that's a theoretical risk. I've never seen a stock hit infinity. Have you, Corey? I haven't seen one hit infinity yet.
No, but it certainly is possible for a stock to go up enough and for you to just stay
like
in a bad position long enough that you could feel that way. Yeah,
to
exactly.
feel like it. So what's happening right here is I'm looking at this and I'm saying, okay, here's the first dollar move. Maybe, maybe here's, $1, or here's like $50 and here's $60 and here, or $51 and here's $49. I'm pretty locked in with my delta on the first dollar move. But in the second dollar move, this is getting steeper, and the third dollar move, it's getting steeper, and the fourth dollar move is getting even steeper. And these are usually, pretty smooth graphs. And you can tell by that next dollar move how nasty, things can start to get to you. And so gamma risk right here is simply telling me how nasty, or really maybe even this is how fast this could get nasty. That might even be a better way to put it. How fast this could get nasty, really nasty. And we'll be talking about gamma risk in certain types of trades, but it's not something that we log in our trading journal saying, oh my gosh, here's my gamma risk. What's most important for the trading journal is to know my maximum risk. And if I have a maximum risk of infinity and that makes me nervous, then I'm probably going to say, well, at what point am I going to have to do something? What's my plan to fix this thing? And I might just take a moment and glance at my gamma risk to say, how fast could this really go nasty? What would you say about that, Corey?
Yeah, and you don't have to take unlimited risk. That's part of the joys of the options world. So if you probably noticed the long call and the short call are the exact same trade, just one's flipped upside down, right?
Yeah.
And so every trade in the options market has an inverse, because you can take the long side of the trade or you can take the short side of the trade. And whatever is reward for the long is risk for the short. Whatever is risk for the long is reward for the short, right? They're just the inverse. There's a buyer and a seller. Whatever good for one is bad for the other, that sort of concept. And so when you think about this trade, this long call position, we know that delta starts at a certain delta, but eventually it gets to 1. So the gamma represents how it gets there. Maybe in the first dollar move, it's a 50 delta. And then the gamma is 20. So the next dollar move, it's now at 70. And then the gamma is 15. So now it's at 85. And then it's at 5. Now it's at 90. But eventually it gets to 1. The short call is showing you how that delta is moving in the other direction, kind of going against you. So in this case, you're in a short call, you're basically on the opposite side of the long call. So if it's going up, that's hurting the short call trader. And so how fast that delta increases is a bad thing for you, because that means you're losing money on that side. Well, the silver lining, we don't have to do a short call, which has unlimited risk. And in fact, that's one of the most risky strategies out there. The better approach in many cases is to simply trade it as a spread. I can get all the benefits of the short call, but I can cap my gains. I can, cap my losses. And so I can make it so that in the worst case scenario, I only lose X amount, and I can plan for that and so forth. So there are some advantages to each one. There are times where you can use a short call or a long call position, and then there are hedges and adjustments. So it's really cool. It's fun. It gets exciting as these things start to come, and make sense.
Yeah. What's interesting is, a minimum delta. A minimum delta is 0, and a maximum delta is 1. And so we have, everywhere in between. So gamma is just saying, look, how fast is this going from where it is now to a delta of 1? So if I were to get fancy, which I probably shouldn't do, but in reality is once I get a delta of 1 right here, so we'll just call it, 101, like that. If I were to just gone one more, it would go flat right there, because it couldn't go. It can't do any more than 1. So, anything you want to say about that?
Yeah, it would just stay at that steady pace. It's kind of like if we're using the car example, it's like you have a governor on the car. You can't go beyond 100 miles per hour. That's it. That's its top end speed.
Who would buy
that? And so with
car?
options, it's the same thing. Yeah. you need something with a little more speed if you need to go faster than 100. So maybe if you're in the Autobahn or something, that's not going to work. But
yeah. And it would really go to 1. Okay, so let's take a look at sensitivity to interest rates. And, by the way, these are not perfect representations. These are ideas. Okay, a mathematician would do this differently, than we've done it. But it gives you a visualization of gamma. So, and that's sufficient. I'm not worried about being wonky on gamma. Look, it's how fast things can get nasty, and when they go to 1 and it's against you, that's pretty nasty. That's like maximum nastiness, right, Corey?
Yep, exactly.
It's
right.
really nasty. RHO. You know what I'm going with this, don't you? Row your boat gently to the Fed. merrily. Their life is in a dream world. There's a new song. Row your boat gently to the Federal Reserve. They're merrily in a dream world. So here's the Federal Reserve Bank. It's really actually not a bank, but we'll let them pretend that they are. We'll pretend they have reserves too. In fact, we'll let them pretend they're federal. But here you have the Fed, and we have Fed chairman changes and stuff. And the Federal Open Market Committee, the FMOC, they get together a few times a year and say, let's see if we can mess with the rate. And so this is going to affect options. And when Black and Scholes developed the Black-Scholes model, they asked themselves, okay, what is going to affect this stuff? Price will affect it, time will affect it, volatility will affect it, and they'll say, the interest rates has an effect. Corey, why do interest rates have an effect on option premium?
Yeah, basically it's risk-free interest rates, and in essence, it's kind of the cost of capital. You can think of velocity. If we go back to velocity, Well, they measure velocity of money, right? So how much it goes around in the economy, how fast it's moving, and it's kind of a sign of health in the markets when there's more capital available and being used. That's a sign of strength. And usually, when you go into a recession, people kind of scale back, and so the Federal Reserve will actually try to combat that by making easier monetary policy and opening up the floodgates when they feel like the economy needs help, and then tightening interest rates when they feel like, that basically the economy's strong and they need to keep inflation under control. However, I'm not so sure that the FOMC always does the right thing at the right time. They certainly make some mistakes with policy, in my opinion.
I'm not convinced of that, but we do know it affects the stock market. And if you raise rates, that can put pressure on the stock market like we've seen in the past to level it off and even make it change. Well, if I have an option that basically buys time into the future, if I'm in an environment of low interest rates, I might have a different future than high interest rates. So there is a sensitivity to rate. I'm not going to pretend that I've decided to get that wonky and become a financial engineer and get all the math behind that, but I can, and you can, and we can as investors get a basic idea that, interest rates affect things. So, sure, we'll put it in the Black-Scholes model. I'm good with it. That's as far as you really need to go. This class, our effort is we want to be as comprehensive as is smart. Notice I didn't say comprehensive as possible, because if we want, we can get out the Black-Scholes model and dissect those derivatives if you want to. That'd be as comprehensive as possible. But you know what? It's not as comprehensive as smart. That's like me taking apart and needing to understand my cell phone before I use my cell phone. No, I need to know how to operate my cell phone. I really don't need to know how the circuitry works inside. So we're going to leave it at that in a level of comprehension that says, look, do we comprehend that there's a sensitivity to rates? Yes. So why isn't this one of the big three? And why haven't we made it the big four and included this? Well, here's why. We know that delta is how the premium changes with a $1 move in the stock. We know that theta is the sensitivity to premium in a 1 day passage, the passage of 1 day. And we know that volatility, vega, is it sense to 1% increase or decrease in volatility. Well, if I have an interest rate of, say, back in the,
the 80s?
Yeah. Back in, before maybe even 2008, 2007, we had, what were the interest rates back around then, if you can remember back that far? The Fed rate was probably more in the realm of, I don't know what it was, like 5%
5, 6. I mean, back in the 80s, it got up to where it was like 15, 16, 17%. It was out of control. Yeah.
So let's just put this one at whatever point in time you want to label it as. Let's just go 5%. In fact, let me draw this a little smarter. Let's just go 5%, okay? Now watch this. So let's say my option premium at a 5% interest rate, let's say my option premium is $3, okay, $3. Well, what RHO tells me is how much this will increase or decrease my option premium with a 1% jump in interest rates. So all of a sudden here we go, jump up to 6%. In fact, we'll put that in a different color just for fun, 6%. And so that means now it's going to be $3.08. So, do I dare say whoop-de-doo? I don't know, whoop-de-doo. Okay, there you go.
Yeah.
And so, it's like $8 on one contract. Okay, it's like $8 on a contract. Okay, now let's say it falls to 4%. Okay. And now it's going to be $2.92
92,
most likely, if my math is. I get nervous even with that math without a calculator, I'm telling you. So why don't we freak out about this? Well, two reasons. Number one is this is usually not a surprise. This is going to be scheduled. This is a scheduled announcement. Okay.
Usually, and 2008 is probably a good example where Bernanke was the Fed chair back at that time.
Yeah.
And he actually did come on and do some surprise rate changes. So generally speaking, in a healthier market environment, they're going to schedule it and they're going to follow that plan. It's usually a kind of a sign of risk if they're coming out in the middle of a, in between announcements and they're doing an emergency rate change. That's not a sign of, health in the marketplace as a general rule.
So the other thing you got to know is when they do, if they change rates, and we never really know if they will or won't, they usually get pretty good guidance depending on who the Fed chair is. Bernanke could surprise you. He always kind of liked drum roll, please. What am I going to do? Yellen, she gave pretty good guidance on what she was going to do. And we'll continue to watch, all these the new Fed chairmen and stuff as they come in. So it just depends on their personalities. But basically, if it was at 5%, the most likely thing is they rose it. They would say, well, it's going to be 5.25%. And then, maybe the next time, it'd be 5.5%, 5.75%. So they usually don't make the jump all the way to 6, right? So if my RHO is 8, if it goes up, one shot here, it'd be, instead of 8 cents,
it'd be
2
2
would
cents,
be 4.
yeah.
So it'd be $3.02.
2 cents. Yep.
And so we know it's scheduled. And of course, if it went the other way, that'd be $4 or 4.75% probably, which would make this down to $2.98. And the fact of the matter is, with the other three factors involved of time decay, of price movement, I mean, shoot, you can wiggle 2 cents of delta. If your delta's 50 in the first dollar move, you even have that intraday wiggle, you're going to see a 2 cent. You're going to see more than 2 cents. You're making or losing 50 cents on the dollar. The stock would only have to move 4 cents for you to get 2 cents of delta movement at 50 delta. Meaning, the stock can move.
It's very insignificant. Yeah.
So just the intraday movement of a stock of a few cents, just at a 50 delta is going to, give you more movement and more effect on your option premium than RHO. So the reason we're talking about RHO is to be comprehensive to the point where it's smart, to where you know what it is. And the only reason it's really smart to talk about RHO is it part of the equation? Yes. Does it affect, is it in the Black-Scholes model? Yes. And if you understand what it is, you are always scared of what we don't understand. So if we're like, oh my gosh, we never talked about RHO. Okay, well now we've talked about it, and that's smart. Say, okay, I'm not afraid of RHO. Unless we have this massive freaking, maybe you've got some leaps, some long-term equity anticipation securities that you're writing a lot of counter spreads on or something. And there's this nasty news, the whole market's gone to heck, and they make this huge rate change. Okay, well then, if they change at 5% and the RHO is 8, well, then you've got a delta of 40, or a RHO of, it'd change. It would be a 40 cent difference. If it went from 5 to 10, 5 times 8 cents is 40, and you'd have a 40 cent change in your option. And, congratulations. So I think that math is close.
Yeah.
So there you go.
Like we've shown, normally a quarter point. So if they hike by 25 basis points, which is pretty typical, whatever your rho is divided by 4, because it's 1/4 of 1% in that case by a rate hike or a rate decline. So you're taking the rho number and dividing it by 4, to see how much change there is. So we have a $3 option. This is a call option. They hike rates to 5.25, and our option increased by 2 cents. You can see not anything that's all that significant, and there's a reason why a lot of our option chains and things won't even have rho listed. Yeah. It's just not something that we worry about much.
Corey used some good vocabulary. He says at 25 basis points, and I don't know why they don't just say a 1/4%. A 1/4% would be 0.25%, but they call it basis points is I believe the term that Corey used. So there you go. So, row your boat gently to the Fed. Merrily, 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 merrily. Life is but they live in a dream world. So they do, man. If you think you could print money out of nothing forever, you're in a dream world. So you can do it short term. That's reality, but doing it forever, you're in a dream world, I think. Anyway, so that's your 778. So it just estimates how much the option premium is going to change with a $1 move in interest rates. Pretty easy lesson. Don't get in a bind over it. Just this is the important summary. Look, if you get an idea and you basically have a sense that gamma just tells us how delta changes. If we have two stocks and we have, stock A and we have stock B, okay, and maybe we have a call option, on these. And we have a call option here, and they're both $50 strikes on different stocks, $50 strikes, $50 strike call. And, the at the money on this one is 50, and the at the money on this one, the delta is 50. But then you see that the next, move up the delta might go to, on this one, it might go to 80. And then the next move up, you might see it going to, maybe the full dollar. And then this would be down, to 20 and then, to 0 really quick like that. And if you saw this delta going to 60, 70, 80, 91, and this one to 40, 30, 20, 10, 0, okay, quiz, Corey, which one would you say is having a quicker rate of change of delta? Which one is the delta moving faster in? Stock A or stock
So stock
B?
A definitely has the larger gamma.
This has the larger gamma.
Price moves, yep.
Right, this has a lower gamma. This delta only moved, by 10.
10 cents.
This one moved by 30. So, this one would have a gamma of what, Corey?
Of 30.
Of 30.
Yep. And
this one
the other would have a gamma
of
of 10. Exactly.
Of 10. And there you go. So this one simply says, I look at the two stocks and, you can look at it on the positive side. Oh, this one will get me, to a delta of 1 quicker. It is risk and reward, right? But it also will take you, if you're selling it, it can take you to a, delta of 1 quicker. And your life can get nasty a little faster than with the other stock. If you kind of get a sense of that, that's all gamma is. It's kind of nice, isn't it? Just to, to be together and to talk about these things, because if you go out and you start saying, I'm going to look at the delta hedge, the gamma and the rho, you got the theta positive, delta neutral trade, and people freak out. And it's like, gamma's not that big of a deal. It's just, this one, the delta changes really quick, and this one, the delta doesn't change as quick. That's it. It's just a rate of change of delta. How fast does the delta change in English? Rho just estimates how much your option premium changed with a 1% rate change. We don't get those very often. We usually get a 1/4% change. So it's not a big deal. Rate hike will usually cause the calls to go up and the puts to go down, and a rate drop will cause the puts to go up and the calls to go down. Any reason on why that is, Corey, that you want to comment on? Why would a call go up in a rate hike?
Well, it has to do with the cost of borrowing money in essence. And so there's a calculation in there of, it's kind of, to use a bond analogy, it's kind of like bonds in that if you were to already own a bond that's yielding X percent, and then they reduce rates or hike rates, it changes your bond value. It changes the attractiveness of it. And it kind of works the same way, where a rate hike will typically make call options a better value, and that you bought them ahead of time is in essence how it works. And with puts, it works the opposite. If they cut rates, well, then puts have a tendency to go up by the RHO amount, but it's very insignificant.
It is a little counterintuitive, because people think, well, if you raise rates, it's like in bonds, it's counterintuitive to what you think it would be. But if you think through it, it makes sense. We don't need to think through it on this. It's good enough to just know that. And again, a rate hike, well, it's not like RHO is, we should say it will go up a little bit and go down a little bit, go up a little bit and go down a little bit, with a 0.25% change. It's not that much. So well done. On the education continuum, you're really in a good spot at competency with Gamma and RHO. That's a good place if you want to go into tremendous proficiency and go figure out all the equations and stuff, because there's nothing good on TV to watch. Fantastic, but it is cool to know what they are, and I say let's hop in now. What we're going to do next is, now we've got the Greeks handled, and we've waxed on and waxed off the car. So congratulations. Whether you spent a few days or a few weeks or even a month on these 4 lessons, you're now, you've waxed on, waxed off the car. Now you've got that circular motion. You probably have a better understanding of Greeks than you ever have if you took 10 trades in your paper trade account, watched them for 7 or 8 days on the delta, and then watched the same ones again on their theta, and then now watched them again on the vega, and saw how those numbers changed. And then if you're using risk graph software, then great. Now it's time to talk about painting the fence. And here's the other thing that I think is amazing, Corey, is I mentioned that there were so many people that never learned Greeks before they traded their options. There's a lot of people that never really learned how to read the whole option.